A very good afternoon, ladies and gentlemen. On behalf of the Indo-German Chamber of Commerce, I am pleased to welcome you to today's insightful and absolutely timely webinar on US trade tariffs, an assessment post the deadline of the 9th of July and the impact of this trade tariffs on India. This session is hosted in collaboration with our valued knowledge partner, EAC, Asia International Consulting, and brings together distinguished experts to help us understand the complex and still evolving landscape of global trade, particularly between India and the United States. As you all know, today's webinar comes at a pivotal moment in Indo-US trade relations. As you have seen in recent headlines, the United States have rolled out steep new tariffs up to 40% in some cases on exports from over 20 countries. India, however, is not one of them. It stands out. It has so far not received one of these famous notification letters from the United States, and the negotiation at an interim or on an interim trade deal remain underway. There were intense round of discussions, and the US recently extended the deadline for India to strike a deal until the 1st of August 2025. So we have another week to go. And that gives both sides a brief window for the continuation of the talks. Reports indicate that efforts are on to secure a tariff rate for India of less than 20%. Which would help preserve its competitive edge in the US market, especially as many other nations are already facing or may face much higher duties when they export to the United States. Interestingly, despite the urgency, India has made it very clear it will not rush into an agreement, nor will it compromise on certain sensitive sectors like agriculture and dairy just to meet the deadline. So that is going to be interesting how that is going to develop. The message from New Delhi is unequivocal. Any trade deal must be mutually beneficial and rooted in the national interest. Amidst all of this uncertainty, the session today will offer a timely and comprehensive analysis on how the US policy is reshaping global and bilateral trade dynamics, on key sectors and opportunities arising in the context of ongoing trade talks, the current status of the tariff negotiations and what it means for Indian businesses and Indian exporters, and of course, your questions on how to best navigate through the months ahead of us. With export growth to the US still strong, but the future access, as just explained, is unclear. This conversation is especially crucial for Indian exporters, manufacturers, investors, and all those invested in the in the Indo-US, obviously, economic corridor. And we are pleased to have with us Mr. Ketan Jadhav, partner of EAC India, who leads the firm's India operations out of Mumbai. So very warm welcome to the neighborhood. With over 11 years of experience and more than 40 consulting projects across India and Southeast Asia, Mr. Yadav has been instrumental in shaping strategies for sectors such as industrial machinery, infrastructure, automotive, and agri-tech. But before Ketan deep dives into the discussions, I'm honored to welcome our first speaker, Mr. Dietmar Kusch. He's the founding partner of EAC International Consulting Munich. With over 30 years of consulting experience across Asia and Europe, Mr. Kusch is a strategic leader whose expertise spans over engineering, industrial goods, automotive, infrastructure, and the energy sectors. Prior to founding EAC in 1993, Dietmar held leadership roles at Siemens AG and at Roland Berger, supporting global strategy development for internationally operating firms. And with that, now it's my great honor and pleasure to hand over the platform to Mr. Kusch to begin today's session. So, Dietmar, over to you.
Thank you, Stefan, for the kind introduction. Good afternoon, ladies and gentlemen. First of all, I would please allow me to thank the Indo-German Chamber of Commerce, especially Nivedita, and the entire team for the organization of the webinar on the actual far-reaching implications of the current US trade and import duty policy on the global trade structure. It is both a pleasure and honor to join you for this important discussion today, centered on the future of manufacturing and global trade amid dynamic geopolitical changes. Please let me distinguish the import duty impact for three different global regions. I would like to start with US and China. Today, global tariffs, relations are here in sharp focus. We see the repercussions of mounting tariffs up to 145% between the US and China, not only in the flow of goods, but in the decisions of multinational companies regarding investment and supply chains. The second region, Southeast Asia, Japan, Korea, most recently the United States introduced an expanded set of tariffs for 14 additional prominent Asian manufacturing economies like Japan, South Korea, Thailand, Malaysia, Indonesia. These sweeping measures coming into effect in August are reshaping global supply chain and forcing manufacturers worldwide to immediately reassess their production and export footprint. By the way, Trump announced last night the deal with Japan, which will see 15% reciprocal import taxes on both sides. The 15% rate will also extend to automobile and car parts, compared to other regions like China, like South Korea, which have faced a 25% levy on automotive sector exports. Coming to India, compared to this newly target group, India is currently facing a much more lower US import duty. Stefan Loser just mentioned this. Development presents both an urgent challenge and a very interesting, significant strategic opportunity for India. We have to compare this, of course, with China. The foreign direct investment in China, for decades, the world's major manufacturing hub is significantly slowing down. In contrast, countries like India are emerging as destination of renewed interest, with FDI reaching 85 billion euro in this situation. The next we had already 5 rounds of negotiations with the US authority in India. The next round in August will take place. The US delegation is planned to visit India. Hopefully, the achieved status can be defended by the Indian authorities and could offer a certain competitive edge against the other region. In this context, it is my pleasure to invite Ketan Yadav, our Indian partner, to take the conversation forward. He will walk us through in a detailed presentation on the current tariff environment, its impact on FDI flows. We may just realize actual ESE investigation where he will identify the industrial sectors which could benefit from the actual import duty situation. It is now my pleasure to hand over to you, Ketan. Thank you.
Thank you, Mr. Kush. Let me share my screen. While I share the screen, I'll also like to thank Indo-German Chamber of Commerce, Mr. Halusa, and the full team for giving us the opportunity to share our knowledge on the topic. Now, I'm just a moment. Okay. So, I hope you all can see my screen. Niveda, if you can just confirm it.
Yes, we can see your screen.
Good.
Yeah.
Good to go. So, ladies and gentlemen, thank you very much for taking the time to attend this session where we are going to talk about the India opportunities from arising from this USA reciprocal tariff announcements. I have divided my presentation into 4 segments. First is the very quick introduction of EuroAsia Consulting, knowing who we are and knowing your speakers, of course. Then B is the overview of US tariff announcements, recent developments, setting up the context and also understanding why US has taken such steps. The C part is where we will address all of your interest, which is basically India opportunities. We have done the brief overview of the sectoral assessment. I'll present the results of the same. And the D is the conclusions of what are the key implications for all of us who are operating in India, who are having presence in India, and considering the US as one of the key market for our business. Now, coming to quickly on the EAC introduction, we are a 30 years old management consulting firm. It won't be, let's say, if I say that we are one of the largest management consulting firm between the India and Germany ecosystem. So we have been operating with the two offices, one headquartered in Munich and another in Mumbai. Along with that, we also have offices in Shanghai, Kuala Lumpur, and New York. We have executed more than 700 consulting assignments into these regions. The key competencies are across manufacturing industries, and the functional competencies are conventional management consulting services, which include strategy, M&A, operational excellence, which is cost optimization topics, and the sustainability. With the 90% of our business, or let's say clientele, is from Germany or from the DACH region, we have also supported Indian market leaders including Thermax, Larsen and Toubro, or even Nosil and Rubber Chemicals, VST dealers, to expand themselves in Western markets. Now, quickly coming to the actual topic and setting up the context right for all of us. The first topic which I would like to share with you is why is this happening? Why reciprocal tariffs has been announced? What can be the reasons for Mr. Trump to really, or Trump, not only Trump, but the team which is sitting behind of all of this, why they are acting or why they are taking these measures. So very important to understand is the left side graph, the USA trade balance. If you look at the trade balance of USA, which was positive in 1960s, it has came down tremendously, and really important to notice after 1995 when the World Trade Organization was formed, to $1 trillion negative in 2024. So that's one of the key concern for US, that they are, the trade balance is significant, the negative in significant amount. And China also joined the WTO in 2001, so therefore lots of share has been taken over by China and the other Asian countries for the US markets. So that's one of the pain point for US right now, and therefore we see that they are defining, or let's say they are defining the new trade rules now. They are actually going against their own establishment of WTO. There are other reasons also beyond the trade balance. One is the manufacturing GDP share. If you look at their GDP share in 1947, it was 28, and it has came down drastically to 10% in 2024. So the overall dependence, or let's say overall strength of manufacturing has gone down in last 60 to 70 years. More often they are now into the technology transfer. They transfer the technologies to the new developing countries, and then these countries manufacture the products and then export it back to US. So that's one of the important pain points which Trump and his team is trying to address, to receive the investment back or to get the investment back into USA. High interest rates, for example, in last 2 years only, you can see the steep increase in the interest rates. It's currently 4.5%, and it was 0.25% in 2022. Debt levels, everyone is aware, USA is having very high debt levels, and one of an additional problem is the treasury, basically to borrowing limit of USCs also have reached the ceiling limit of 36.1 trillion USD. So the message is that they cannot really borrow more with the treasury or the bonds what they used to. So they are in severe problem with the overall fiscal deficit and the trade deficit. Therefore, they are taking these important measures. Of course, this cannot be only the receiving the tariff income will not address all of these problems, but there has been a bigger elephant in the room, is basically reducing the imports dependency. The possible impact, when I say possible impact, that if they have now they have taken these steps, and if they are able to successfully achieve the results, the what would be the different impacts which we can assess, or let's say on the overall global economy or US. One, there is the theory of currency accord, which is not published or which is not talked about. It's basically there can be a hidden agenda of US government to really ask these countries against the trade agreements that to continue pegging their currencies against USD. Whenever US dollar get weakened or stronger, then these countries have to play a role to balance the US dollars. You would have seen very open an announcement from Mr. Trump for the BRICS to really control, or let's say not to discuss the replacing USD in this BRIC summit. Another would be incentivizing the foreign companies to move their production capacity to US to create domestic jobs. Now, this can be of question mark considering the current global setups, which are more focused on the cost optimized locations. US is no more the low cost producing production economy. So that can be a question mark, but that's one of the possible impact we can see with the US headquartered companies for sure. Then coming to the revenues from tariffs, which will help to reduce the fiscal deficit, and it can open for the tax cuts in US, which can again make investments in US more attractive. So these are the reasons why these tariffs has been announced, why this team has taken this drastic step. The only discussion point would be, will they able to success, will they able to achieve the success what they are really desiring? That time only will tell. Will come to the opportunities for India quickly after these discussions. Now, if you look at the reciprocal tariffs announced, what we have is the largest, let's say, economies of the world, starting with European Union, China, Japan, and the tariff announced on 2nd April was really was shocking for all of us. But now today, as of now, the tariffs as of now till date is European Union is 30%, China is 30%. There are some trade discussions going on, but as of now, this is the status quo where India is at 10% right now. And as Mr. Halusa, Mr. Kush already mentioned, that there would be negotiations again, ongoing negotiations are with India, which will take place on in mid of August, where USA delegation is coming in. So this 10% may change in next 1 month or so. But fingers crossed, we will be in that advantageous position today as we are in today. Then UK, Brazil is one of the highest country to get this 50% of the import duties. Canada, Mexico, and then the rest of them, mostly in range of 10 to 30 to 40%, and only exception is the Brazil, which is 50%. Now, coming to the update on the trade deal discussions, India, as Mr. Alus already mentioned, the key elephant in the room is the farm producers and dairy. The farm producers, you know that how's the India act on the anti-dumping or the protection policies when it comes to the investment from the global economies. Wherever we are strong enough to cater the domestic needs, or wherever we have the domestic industry very stronger, we don't allow even our free trade partners to import those materials to India. And then farming, or let's say the farmers of India are anyway one of the sensitive topic in India. And this is where the discussions are kind of dragged for last 2 to 3 months. And now, and hopefully we'll get the conclusions in the next round, of the sixth round, which is scheduled. Going into detail, what US is demanding is the reduced tariff on the industrial goods, EVs, wines, petrochemicals, and also the in farm exports, genetically modified crops. The others, like other products like dairy, chocolates, cookies, and also interestingly, also demanding to address the issues like quality control orders, which are non-tariff barriers, which is also a market access barrier for US companies and also the global companies, you would all know. So that's also a point for the discussion. What we are demanding is removal of this reciprocal tariff, or 26% or 10% today. Duties reducing on the duties on the steel, which is 50%, aluminium and automobile on 25%. Tariff concession for the labor intensive sectors like textiles, leathers, and the agricultural producers. And then opening up the overall access to the dry fruits and apples for US products. We are still, as I said, we are still resisted to open up our economy for the farm producers, mainly for corn, soybeans, wheat, and dairy products. So this is where the status quo is. Now, jumping into the evaluating the opportunities for EAC, for India, from the EAC's analysis or EAC's perspective, if you look at this chart is highlighting the economies with the import share to the US. So the green ones are the countries which has less than 1% import share or the export share to US, and the red ones or the brown ones, maybe the top 18% is European Union countries which are having the 18% share of export, or let's say US's largest trading partner is Europe, which is having 18% share in the imports, followed by China, Mexico, and Canada, which these three countries accounts for around 36 to 37% of the total imports. And then we have the other leaders like Japan, South Korea, Taiwan, Vietnam, which are in the range of 3 to 5%. India is around 2 to 2.5% of the overall US imports. And if you look at these all economies, and if you look at the table on the right, so which highlights basically the major trading partners of US today and the import duty on it, India is at the lowest, which basically gives us the advantage of catering, or let's say addressing this cost competitiveness against China, Japan, South Korea, Taiwan, or Vietnam in the range of 10 to 15 to 20%. For example, in China currently we have 20% advantage over the because of the trade tariffs. If we are able to continue with this 10, the opportunities are significant. Even if we, let's say, even the trade like what happened with Japan, which is reduced from 25% or to 15, and if we, let's say, in the worst case scenario, if India goes to 15% in next month, still we will have 10 to 15% of advantage over these major manufacturing countries. So now going into details with this understanding, if you understand the overall requirement of US imports or US market is around 3 trillion euros, out of which 40% share is belong to Asia, which is around 1.2 trillion euro. China has 16% share with 463, whereas India has mere share of 2%, which is only 70 billion euro in imports of 2024. So if you look at the overall opportunity, that we are not talking about replacing Asian economies by India manufacturing, it's not possible in mid to long term for sure. So we, even if we, let's say, double our import share to US to, let's say, 4%, then still we are talking about increase of around 70 billion euro of exports to US. So the opportunities for India would be that Asian companies setting up assembly units or manufacturing units, shifting their regional value chain to the India to cater the USA exports. In mid to long term, indicates significant upward potential for us. So as I said, 70 billion euro, even if we double the volume, it's around 70 billion euro. What can be the threats for India? Of course, there are opportunities. There is also threat for India, that there can be a dumping, because India is one of the also the largest consumption markets. So in case China or the other countries who are not able to serve the US market with the increased tariff, they might direct their goods to India, which is another consumption economy, or let's say one of the bigger market. Whereas government has already has set up let's say a monitoring group to track this potential increase of goods flowing to India, and that was done in already in April 2025. So this is the overall opportunity which we can quantify. Of course, I cannot quantify with the how much it can be the share, 4% or 5%. That has to be discussed, and that has to be really assessed systematically, which we will do, which will try to do it in few slides for all of you. Now, coming to the understanding the India-US relationship, because that's also very important to understand that how these trade discussions will take place, how's our really trade relation with US has been. The exports and imports has been really increasing in really a significant or the steady manner with around 9% CAGR for last 7 to 8 years. Today we are in positive, we have a positive trade balance. We are exporting more than what we are importing. The overall developments on the FDIs, the developments on the investment going out of India, even discussions on the space collaboration, discussion on the defense has been really strong for last 4 to 5 years. You can see some examples on the chart. And also going forward, we have, let's say, a place to collaborate on energy security, a place to collaborate on the India-US defense partnerships. So it looks really stronger right now, though there were some issues in past also where we have fought with USA in WTO court, we have fought with USA on the different H1B visas, but that still is not it's not really making any damage to the overall trade relationship with US. Now, coming to the approach, let's say EAC's approach to really define the opportunities in the sectoral manner or in the different sectors, there has been, let's say, four prongs, or let's say the four topics which we have assessed. One, the sectors with higher Asia dependency for US. So these are the sectors where USA definitely needs the products and they have very high dependency on Asia. Then there are sectors which has significant manufacturing competence in India, and we are already exporting to US. The third is sectors which government is pushing for last 4 to 5 years to increase the manufacturing competitiveness in India and be self-sufficient, which will also lead to the export competence. And the last one is the sectors with the dominance of Asian exports and the India's cost competitiveness. So any sectors which are having really large exports to from the Asian countries, and India where has the competitiveness without incentives. So these are the four assess, or let's say these are the four parameters on which we have selected the sectors. Now coming to the assessment, the the present chart is basically highlighting 11 sectors with more than 50 billion euro imports to US. If the left, you can the left hand side will show you the total imports to US, and the bottom is basically the Asia share on the US import. So for example, electric equipment, the yearly export or the import of US is around 400 billion euro, and the 68 to 69% is import dependency on on Asia. So these three big, for example, electrical equipment, mechanical equipment, or vehicle parts are become really high value sectors wherein Asia share is more than 30 to 40%. Then the furniture and rehabs, which would be around 55 billion euro per year imports, and whereas the Asia share is around 65%. So these sectors having really high value imports to US, and the in the sectors which are highlighted in the red are the sectors which I was talking about, assessed on the four parameters, where we have good competence in the products, we have good competence, or let's say we have support from the government side, we have cost competitiveness in these select products. And now if we talk about the opportunity on the from the let's say value perspective, if you look at the mechanical equipments, I'm talking about the top three sectors, the mechanical equipment, the industrial machinery, the total import value to US is around 467 billion, whereas Asia share is around 243 billion, 52%, and India share is only 5 billion, which is 1% of it. So there is definitely a significant upward potential to assess which can be the products which can be localized in India, which can be the products which can, let's say, put an advantage, or let's say can be more competitive if we consider the trade tariff disadvantage to the China, to Japan, to Korea. Then can we match that gap of 10 to 15% with the India manufacturing, and then India still become more attractive for the US exports. Same for electrical equipment. We only have 2% market share. For vehicle, for automotive parts, where India's 50% of manufacturing GDP comes from the automotive and auto components. So you can imagine the kind of competence we have currently in auto manufacturing. India is only exporting 1%, whereas Asia is exporting 32%. So there is definitely a opportunity, upward side opportunity for all of us to evaluate the products which can be now localized, the products which can be become more cost competitive in considering all these geopolitical and this trade reciprocal tariff situation. Then there are the four sectors which are high value and low Asia share in the green ones, where India has 4% market share. And the rest of the four sectors, including the precision instruments, organic chemicals, plastics, furniture, prehabs, where we have 2% market share. So these are the opportunities which are for the top 11 sectors. But now, if you go beyond these top 11, if you talk about the 87 other sectors, or let's say 87 other HS code chapters, which are less than 50 billion euro imports, low value, but still having high Asia import share, then you can see that toys, sports goods, neat woven apparels, footwear, rubber products, iron and steel articles are the top seven sectors which are having more than, let's say, 20 billion euro of imports to US, and we are having more than 50% dependency or 40% dependency on Asia. And you would already know that what are the segments where India is really strong. I have highlighted from the ESC expertise in the red font that these are the sectors wherein we can definitely localize few products for with focusing on US, or we can definitely grab some share from our peers from Asian markets for the US opportunities. Now, even for example, toys, we are also import dependent, whereas we have now incentives coming from the Indian government on the sector. We have footwear, which where we have very large leather processing industry or the leather producing industry. We have significant experience in that. Rubber products, we are one of the let's say one of the largest manufacturers. Neat apparels, we were neat and woven apparels. We were competing with Bangladesh and Southeast Asian economies for that. But now Bangladesh is going to attract around 30% of the import duties from by US, or the rest of our Asian peers who were strong in textiles are going to have more than 15% import duty. So now India's textile industry can become also more attractive considering this cost advantages. Even if you talk about the below part, where basically we are talking about the low value imports but high dependency on Asia, you can see very important sectors like leather goods, the used textile rags, heat gears, the cotton products, the textile yarns, where we have companies like SRF, Garware. We have glasswares, we have non-woven yarns. So these are some good examples where India can definitely get advantage compared to the Asian peers. And if you look at again the number which can be attractive. For example, the top seven sectors, the total import value we are talking about is around 237 billion euro, and the Asia share is around 68%, 161 billion, and India is only 4%. So even if we double our share to only 8%, and this 9 billion can turn into the 18 billion, it's still we are talking about 9 billion euro of increase of the exports, which can be beneficial for lots of small and mid-scale or the micro MSME companies in India. The 31 sectors with the high Asia dependence and the low value, where India is having around 5% market share right now. Even the seven sectors with the high value in the green but the low Asia dependence, where India has only 1% market share. So, but the value is still is in double digit, or let's say the 20 to 25 billion euro across all these sectors. If I put it into the examples of the products, for example, so I have selected this cautiously considering the Indo-German platform, where we have these HS code of 84, where most of the German counterparts are into. For example, shaft bearings and gears. The US is importing 931 million euro, and India share is 9%. Now, this 9% is basically exported by Kalyani Forge, it's exported by Renault, it's exported by TVS Usha. Renault is exporting gearboxes from Chennai plant to US. So that's one of the major export opportunity Renault has seen. And now with this new trade advantage, Renault, or like the other gearbox companies, can now benefit more for compared to their Asian peers or the Asian dominance. So this is where we see definitely a big opportunity. Even for if we talk about the forklifts, where the Gautam Ingicast, even if you talk about the ball bearing runners, NRB is one of the biggest exporter to US. The Timken or Harsha is one of the biggest exporter to US. Now these companies will definitely get a good opportunity is to increase this 6 to 7 or 9% market share to 18 to 19% for sure. So these are the product level assessment. Now, what is the implication for all of us? Understand, we have understood the overall or broad level opportunities. We understood the how big can be the opportunity for all of us. It's we are talking about the billion euros for India. Now, how it can be really leveraged? What are the strategic implications for us, or what are the strategic questions which we have to address? So first and foremost question is, can we manufacture these products at the cost competitive manner considering our peer countries? So we have to do the product feasibility assessment, we have to do the manufacturing feasibility assessment, considering the availability of raw material, considering the availability of, let's say, the cost of utilities, considering the logistic cost, wherein India, believe me, we have done the assessment for one of the company recently, and the multiple companies in recent past, where we have assessed the India manufacturing attractiveness compared to China, Southeast Asia, and the East Asia. And India has been always one of the important, or let's say one of the significant cost competitive market uh, for the manufacturing of these machines or the products which we have just presented. There has been issue, let's say there has been some bottlenecks with India when it comes to the incentives offered by Thailand or Malaysian like countries, where you get 8 to 9 years of let's say tax holidays. But now with this trade deficit, this will definitely take away the advantage of these Southeast Asian countries, or even on the labor cost advantage of Vietnam, which will definitely have now a higher let's say lower weightage now. So therefore we have to really understand, can we manufacture these products at the cost which is expected by the US markets? Other than that, can we really produce the at the quality which is expected? And we have done recently some supplier audits for the European firms, and we understood that the quality of Indian suppliers has been really improved a lot in last 10 years. The way we are, the tolerance levels we are able to manage, the quality which we are able to manage, it's really increasing day by day, improving day by day. Then coming to the contract manufacturing opportunities, we are in touch with lots of global suppliers or the manufacturers. You would have your customers not only in US but also in Europe, in Asian countries, and also the suppliers in these countries. So there can be a shift from these manufacturing from China, Southeast Asia to India, even not the complete manufacturing, but at least the assembly for the same. And we would have some overlaps with when it comes to the QCOs and the topics like BIS. We anyway would have some overlaps to look at when it comes to the manufacturing opportunities or assembly opportunities in India. So the contract manufacturing can be also one of the important option which we all have to assess at the product level, very specific to yours. Then German companies with India manufacturing, what we have done recently, and therefore I have included that as an opportunity and the strategic implication for all of us, that risk assessment of the different plant location we have globally, and then checking the what is the manufacturing advantage going to be when it comes to the catering US markets. Which plant globally is having that advantage, and India would be there in the top one or two locations for sure to cater the India markets. And then the discussion with the management or the discussion with the strategy team can be assessed or can be initiated to really which products can be localized in India and can be exported from India. The redefining the global supply chain strategy, that will definitely has let's say this overall topic has a definitely a big implication on the same, where we have to assess the geopolitical and economical risk factors to define these new sustainable global supply chain. And just to have some let's say concluding remarks on this, that this is going to really impact the overall global trade situation, where we were talking about the open markets and the free markets for all the economies, the overall globe as one market. That's not going to happen considering the today's scenarios, there would be lots of one-to-one discussion. There would be lots of one-to-one deal discussions happening. Lots of interest are taking, let's say, have been really taken in the consideration for the different FTAs. So this is definitely going to be a very important aspect to really check the changing situation of this global supply chain, and the redefining your own strategy, and really understanding the risk which are associated with it. So this is it from our side for today, and now I'll be more than happy to take the questions. Though in the while I get the questions from your side, I have also got some questions during the registration. So meanwhile, Niveda, I can address few questions there, and then
Sure.
you can ask some questions. Sure. So one
Yeah,
of
the
the
questions have
very
been assigned to you.
actually I'm not able to see it. I think I have to
Ah,
unshare the
sure.
screen, right?
Yeah, you can
Okay.
stop sharing the screen if you like.
Yes. So before unsharing the screen, there are contact details mentioned for me and Mr. Kush. You can always reach out to us in case you have any questions. You can reach out to us in case you have any questions on this presentation or the clarification you need. Niveda, the IGCC team will be sharing the final presentation with all of you. So you will get the full presentation along with some hidden slides, the backup slides for your reference. Just let me unshare the screen so I can view the.
Mr. Jadhav, all good? Yeah.
Sorry, I'm sorry, I was thrown out. So, taking some questions from the registrations, there were some interesting questions. So, for example, one of the question I would like to address is uh, how is going to impact the technology transfer from USA to India in the areas of defense, semiconductor, and the high technology sectors, or even healthcare. So, if you all know, or if you all remember, our IT minister was in US 2 years back, where we have signed the MOUs with more than, I think, 15, 20 companies to get the semiconductor investment in India. Now, what will happen to that, considering Mr. Trump is not really allowing the technology transfer to go out of the country? Technology transfer, yes, but not the manufacturing. So how it's going to impact? So of course, that was in the region of Mr. Biden when it has happened. Now it has some negative impact. There has been maybe a slow progress on the technology transfers coming from US, but I think we have to wait and we have to wait and watch what happens in next 15 or 20 days when the USA delegation coming to India, what has been the conclusive discussions with these team, and then we'll understand what will the impact on the technology transfer. But that's not going to be, doesn't look very positive right now. There is another question came to us was, would you like to understand how Europe and India is trying to leverage the India manufacturing supply chain in the era of China plus one? So it's very important question that the how this overall Western hemisphere is really addressing these situation where the China, or let's say even India or the BRICS nation, are really taking over the lots of market share. So if you, as Mr. Kush has already addressed that in the introductory remarks, that India has been the winner of this situation with the, even if you look at the FDI numbers, India's FDI has increased by absolute numbers of 10 billion euro in the last one or in the last financial year, which has been one of the largest growth of FDI receipt in last 7 to 8 years for sure. Whereas China is collapsing, or the China FDI is collapsing. So we are anyway going to get really benefited from this manufacturing competence, and then all the companies in the era of this China plus one has to consider India as one of the best, or let's say safer option, which is also politically neutral to the different economies, which can be safer option for the investments in near future. Very interesting question again, that how long are these new tariffs are going to stay? Is there any minimum fixed time for the same? And how is this industry going to plan any otherwise? So, very, very apt question. It's really uncertain. And I was discussing with Mr. Kush earlier about this question, and what we concluded is, of course, it can be a short term also. It once Mr. Trump is out of the power, there can be changes. But if you look at the overall US situation, if you look at the overall US economic situation today, uh, with these increasing revenue coming into the economy for next 3 to 4 years, any new government coming in has to think twice to reset the button and coming back to the previous normal. So it would be difficult for the new government also. So I think this will stay for the longer period. This won't be a short term uh, action points or the benefits for the, or let's say the, for the US. This will stay for sure, but there would be no winners in the long term. In case the way the trade war has started, no one will be the winner of this situation. In case of trade wars, all economic parameters, you can also see in the US itself, or we are heading towards the global recession. Maybe we are heading towards the cost increase, the inflation will be at different level in US. So there would be, so in conclusion, this is not very healthy for the global economy. This will definitely, there would be some learnings for all the economies, there would be some learnings for all the key leaders, and also the WTO itself, in case we are able to address these questions on more sophisticated manner, the issues in more sophisticated manner. Okay, then I have one more question, which is basically higher import, or let's say export dependency on USA from the global business. Then how to really address that? I think, uh, and they have the plant in Germany also and in India also. So I think it's really, as I mentioned, it's really important to have a cost competitive advantage, or let's say assessment between Germany and India now to address the US markets, including the manufacturing cost, including the logistic cost, including the trade cost. And I think India would definitely save around 25 to 30% of your cost anyway. This is what is coming from our recent assessments, or recent uh, an assessment done for the companies or clients. Okay, I'm now just going through the questions. Is there good chance on pharma sector after the tariff negotiating? Of course it is. Pharma has been always a key point for the discussion between US and India. We have been really a good net exporter, I think, so for the pharma sectors. Pharma sector is under anyway in the discussion, uh, but there are no more details we have as of now. They have really not published the sector-wise discussion with US. Only we have, what we have in the public domain is only pharma and the dairy sector. So the question is, what about the quality differential between East Asia and India with respect to your exports? Very important question, Mr. Singh. As I mentioned, we have done multiple supplier audits recently, and for even electronics, for aircraft parts also, India's capability of producing the quality components has really increased. India's automation, the focus towards the advanced technologies is increasing. Of course, there are some suppliers who are not able to match it as of the quality as of now, but there is definitely, we see a certain increase in the quality levels. and that will come along with the support from the technology partners from Germany, from Japan or Korean side, where Indian companies are willing to really collaborate with these companies for the technology transfers, or even now with Chinese. So currently we are addressing this BIS and QCO topics against China companies. So Chinese companies are now coming forward to share the technologies, or even share the send the assembly machines to India, where our employees or our labor will get trained on these on all these technologies. So we definitely see a good increase, or the competence increase there. There are so many questions. I'll see how much I can address. So there is a question: who will shift business from Asia to India? Will it be majorly Asian companies, or will it be European companies in the Asian countries shifting to India? I think we have supported multiple European companies to not shift their business, so they can still have their business in their own country, but the expansion of the capacities can be done in India. India can be one of the additional location, and in case they are facing very significant cost disadvantages, then yes, then shifting is the option to India. Now talking about the Asian companies evaluating India as an opportunity, as I said, now considering this trade at disadvantages, anyway most of the Asian companies, excluding Chinese ones, have good presence in India, any in the sales presence or even the manufacturing presence in certain sectors. Now it's the question of, can they expand their manufacturing footprint in India? Can they increase the overall value chain presence in India? And we have been supporting some Japanese companies in agri machinery for example, and we have found really positive results when it comes to the cost comparison between Japan and India. And when we discussed India, we also compared Vietnam, Malaysia, Indonesia for that matter, and India was at the par when it comes to the cost competitiveness. So I think Asian companies are also not shifting is not the right word, but expanding their footprint in the Indian market. Will India go for it? Okay. The similar agreement of US in India. Uh, Very interesting question again. That will India choose to opt for the higher tariff of around 24-25%, or we will protect the domestic industry of agri or dairy what we have. So I think India will definitely protect the way Indian delegates on the or the Indian overall political discussions has been, or the messages coming out of the from the top leadership, from the external ministries or from the delegation which is in US. I think we are definitely talking about defending our domestic markets, but which are more sensitive markets, where we think that where we have good competitive advantage. I don't think they will be really protecting that. But the industries which are sensitive enough, like farming, like dairy, or even textile, this is where we will be more protective, and this is why the discussion is really dragging at the moment. And considering the overall interest of US also, there are also, let's say, topics which are not in public today. For example, there are lots of, let's say, topics which will be off the table, let's say, which is off the public discussion, kind of discussion with Russia, the discussion with the USD, discussion about the discussion of the currency accord, discussion about the Russian trade. So these are the topics which are not openly discussed in the public domain. So these are the some triggers which will now, let's say, give India advantage to protect their own industries. So it really, we have to wait until we get the decision, or on the Asian on the in the mid August from this team who is negotiating it. But I am very positive that India will be at the same levels, or more or less below 20 for sure. Okay. Any developments on import of genetically modified corn and soybean in India? No, as of now, we don't have any inputs from the team, or let's say uh, from the negotiation team. It's not yet public. So another very interesting question is what is the impression of European companies of our Indian SMEs? As I said, Indian SMEs were having, let's say, a very mixed impression earlier of present, let's say, producing a let's say moderate quality, not able to produce it at the quality which is expected in Europe or US or even any Western markets. But it's now changing. It's now changing really rapidly. So the European companies are really looking at India as one of the cost competitive and quality manufacturing. The only bottleneck here I see is the mindset of having large volumes production, mindset of having a production at the larger scale, which this is where we are really lagging behind compared to China. So China can produce it at the larger scale at the best quality. Can India do it? Of course, India can do it. India has that. That's a mindset problem, I think, and we will able to conquer that with the overall investment coming in, the overall leadership changes in the industry. So I think this I'll stop here, and most of the questions, whatever the questions I have received, I'll try to address it over the email. In case you have further questions, you can always get in contact with us. And now I'll hand it over to Mr. Kush and Niveda for the closing remarks.
Yeah, thank you very much, Ketan, for the very, very interesting statements and for the very interesting questions coming out of the discussion. I think we can summarize on the one side, the import duty, I would like to say the import duty crisis leads at the end to a global unbalanced situation globally. The US consumers, they have to accept at the end increasing prices due to the imported inflation. The intended stimulation of foreign investment coming into US can be in general questioned. A foreign investor will not invest into an environment which is characterized by uncertainness and high volatility. If you look to Germany, a strong export-oriented nation, actual losses every month more than 10,000 industrial working places. For India, the import duty crisis could offer, on the other side, what Ketan explained clearly, opportunities for manufacturers, considering India as potential platform for assembling and for reaching the US and global markets. They can extend the footprint, choose other business model, contract manufacturing models. So there are a lot of alternatives, but at the end, these kind of new value chain strategies must be carefully prepared, careful strategic preparation, permanent assessment of the options which are available, and of course, detailed understanding of the regulations which are required. I thank you very much for your kind attention in the round, and I'm again handing over to the team of German Chamber of Commerce. Nibida, if you would be so kind, take over.
Yes. Thank you, Mr. Kush. On behalf of the Indo-German Chamber of Commerce, I would like to thank our knowledge partner, EAC, Eurasia International Consulting, for their valuable collaboration in making today's webinar possible. A special thank you to our distinguished speakers, Mr. Kush and Mr. Ketan Jadhav, for their deep insight and timely analysis on the evolving US trade tariff landscape and its implications for India. And of course, a very heartfelt thank you to all the attendees for your active participation and thoughtful questions today. We hope this session offered you meaningful takeaways to navigate the road ahead. We look forward to your engaging with us at our upcoming webinars as well. So thank you and have a good day. Thank you so much.
Thank you all.
Thank you.
Thank you, Nevada.